So today in this video, I'm going to talk about how to model for volatility in the financial market, right? If you're a trader, if you're an investor, or you are interested in learning finance, I think one of the most important thing is to understand volatility, and then to understand how to model for it for the future. In case you want to do data analysis or mathematical modeling on financial asset pricing or forecasting financial assets, prices of the financial assets, you really need to understand volatility in detail. And you also need to understand the challenges faced in volatility forecasting. So why I've made this video is because when I come across, there's young traders, a lot of them retail ones, they only worry about the mean price in the future, but less worried about or not at all worried about the volatility aspect of it. And this is typical with a lot of the young traders. Volatility is extremely important actually, right? Because it's not just about return, right? Return comes from your mean, but risk is assessed through volatility or understanding of volatility or quantification of volatility. Very important, therefore, that you understand volatility uh, and how it should be used in quantitative modeling and risk management, right? Whether it is forecasting or portfolio management or let's say risk management, pricing of financial assets, volatility plays a very big role, right? And there are several challenges with respect to volatility. Several challenges. I mean, there are it's not that easy to actually build a proper volatility model. I'm going to talk about that also, right? So if you learn financial econometrics, that's where you learn the volatility models, the arch model, the garch model. These models are used to forecast volatility of a financial asset, right? And people normally worry only about the mean. They use an ARIMA model, a LSTM model, and forecast the future price without taking into account the volatility aspect of it, and that's a grave mistake, especially in the financial market. That's actually a problem, right? So fluctuation of prices or returns is essentially known as volatility in the financial market, right? If it is fluctuating too often, that's actually a problem. If it fluctuating too much, that's also a problem, right? And both need to be captured in your forecasting model, right? How do you do that? Well, it's important that you understand first of all why it is important, why it is necessary that you also worry about the volatility aspect, not just about the mean aspect, right? You forecast, okay, what would be the mean or the expected return for a given asset for the next 1 year time period, right? So that's one good thing, but what you really need to worry is what is the expected volatility also in that prediction, right? That comes from the volatility model, and many people just ignore that and look at just the mean prediction and take decisions just on that, which is actually not good, because if the volatility is high, it also means that it's a very risky bet, and the decision should be taken accordingly. Especially this is important for retail people, retail traders. This is well understood in the institutions, right? If you work at a bank, it's very unlikely that you just do a mean prediction and go for an investment decision. That's almost unlikely. You also build volatility models, understand volatility, and do the assessment on that. Volatility indicates high volatility indicates high risk, right? And unlike mean predictions, where historical data is what is used mostly, and the volatility is when it comes to modeling volatility model, historical data is good, but it's not always good enough, right? The tail risk is a big issue in volatility modeling. That means extreme deviations from mean or extreme observations. For instance, high volatility during the election results, Now you see it's happening in after the Indian election. But you also see that in other events. For example, during the Corona time, we saw volatility in the market. If there is a natural calamity, earthquake, or any of that happening, there is volatility in the market. If you use this data also in the model, historical data, it is this the tail part becomes very difficult. How do you use that model? You can completely ignore that, because then the model makes no sense. And if you keep that in the data, it's very difficult to build a model and do a proper back test. Right? So yeah, so taking into account or considering for the tail risk in modeling volatility is always a big challenge, right? So if you want to learn volatility modeling, I think very important to first understand the role of volatility in the quant modeling or risk management or even finance, right? People always talk about the expected returns and what is the mean return, how much the price of given asset has appreciated over time. But nobody really cares about the volatility of it. There was this presentation I once saw. It was on Amazon's Amazon stock price for Amazon, how much it has appreciated over time, over the last 20 years, 25 years, immense appreciation, right? So imagine if you had put in some 100,000 US dollar at the beginning of, let's say 2000, during the crisis, the dot com boom, dot com crisis. You had put some 100,000 in Amazon stock. You would have made some many, like many over 20 million probably in return. But what people don't say is that the volatility of the stock, Amazon stock, or for that matter, any tech stock, is highly volatile, right? And that's also shows that it can be very risky, right? Just because Amazon did give a good return, that doesn't mean that every tech stock has given that great return. There have been many tech stocks where people have lost almost all money, right? So how do you spot that, right? So that is spotted through volatility. High volatility indicates high risk, right? Sometimes the risk turns out to be beneficial for you, and you make good money, but almost in most cases, it indicates high risk. Now, can you put 100,000 US dollar in a stock that is highly volatile, that is extremely risky? I'm talking about 2020. Of course, now in 2024, Amazon is a great business, and it's different, totally different. But back then, it was quite different, right? So don't just look at the return aspect of it or the mean return aspect of it. Also worry about the volatility of the return, or the which is measured through standard deviation, by the way. If you don't know how to forecast volatility through using a sophisticated model, just use just use a standard deviation for the historical data. Take sufficient amount of data, get the standard deviation, and that's the indication of volatility. Of course, there are many things to consider. It's not the only thing that you should be doing. Um, you know, just taking the standard deviation is not a good forecast for the future volatility. You really need to take into account many other aspects of it. Um, Okay, so as I've said, you learn these things in financial econometrics. Okay, very useful topic in the field of econometrics, that how to build volatility models and how to use them in the field of finance. For example, in derivative pricing, that's important. If you're calculating value at risk in market risk, that's there also you use it. If you're building models for trading purposes, yes, you're going to use volatility modeling. So, yeah, very good topic of interest. If you are planning to learn on your own quant finance, then this is one topic you really must learn uh, thoroughly. Time series modeling is by far the most important topic in the field of finance, especially if you're going to be working at the buy side. Then it's quite important, right? All right, so this is also discussed quite in detail in the course that I have built. A dedicated section is there for this. Okay. And all right, just wanted to discuss this, right? And especially this is important for the young people who are coming into finance, and they're always excited about the alpha, the return that is generated, but less worried about the risk side of it. I think, yeah, maybe in couple of years' time, they will perhaps learn. I think they have started learning a bit because of various things, but I think it's only going to. I mean, things are going to be more volatile, right, with the asset prices throughout the world because of the events and everything. And I think people will start learning about the risk side of pricing, investing in assets rather than just a return, right? Very important, and it's also useful in lending side also. But I'm not going to spend much time. It's less important on the lending side, more on the trading side. But a super important topic if you're interested to learn quant finance. All right, guys. Thanks, and see you next time.